Or is it? Well, household employment. So non-farm payroll surveys corporations, companies, and household employment surveys households and tends to capture more small businesses. Uh, so household employment was down 31,000 in January. And the previous month, December, it was down 683,000. So the combination of those 2 months, down 714,000. So which is right? Honestly, this is a schizophrenic report. Hedgeye put out a report today on, I think they called it a ridiculous employment report. And they noted that full-time employment over the past year, has gone nowhere. In fact, it's down a bit. Part-time employment is up 870,000. This is not a strong sign out there unless everyone's going into the gig economy, Uber, Airbnb, and so forth. Now, the other controversial knows that I've been saying it's going to be very confusing. And this is just one indication. Just one more thing before I introduce you or reintroduce you to Brett. When I first started in the business in the late 70s, I was in college. I heard portfolio managers back then talking about the worst mistake they had made in their lives, their professional lives. In the early 70s, after we went off the gold exchange standard and all hell broke loose, prices started going crazy. We had the oil embargo, quadrupling of oil prices. Most economic indicators were in nominal terms. They didn't break out real from price or real from inflation. And because of that, they looked at earnings exploding and they could not understand why the market was going down. And they kept buying the dip. It was a big mistake because what was happening back then was inflation was the only reason earnings were going up. And the market doesn't pay for and is part of the reason we're going to be debating about economic statistics for the next few years. So, why don't we start with this chart?
Yeah, I think it's interesting to hear kind of like you talking about how choppy the macro environment is, because I think over a longer time frame, actually, there's profound reason for optimism and kind of like the technology and kind of like the optimistic kind of macroeconomic impact it'll have creates the near term choppiness. It in some ways, because like the statistics coming off the companies that are being disrupted might kind of overwhelm the underlying productivity gains and price trends that we'll see clear through the end of this decade. In some ways, there's this saying in tech, the second half of the chessboard. And the idea is that if you've ever heard the analogy of, or it's like a story, an allegory of a king who accepts a service from an advisor, and the advisor says, oh, you can just pay me by putting a grain of rice on this first chess square and then doubling it for each subsequent square. And the king's like, this sounds like a great deal. And it only begins to get burdensome as the compounding continues to happen, as you move into the second half of the chessboard, where suddenly he needs to produce grains of rice that are.
Yes, it's very exciting. This chart came out of our big ideas last year. And what you see here is the impact of technology on real GDP growth when there are big breakthroughs. And so, as Brett mentioned, the breakthroughs in the early 1900s, telephone, electricity, internal combustion engine, created a step function increase in growth. And you can see it here Um, the previous years, back to the 1500, the average real GDP growth rate, we think, was, and Brett did this research, 0.6%. There was a five-fold increase in growth thanks to those three major platforms, and we ended up at 3% growth on average for the past 120 years. And you can see now what forecasters are expecting from now until the year 2040. They expect a deterioration in growth from that 3% range to 2.6%. And what do we expect? Well, we believe these five platforms are much more provocative, and especially with AI, the primary catalyst or the biggest catalyst, that the step
remarkable from a macroeconomic perspective.
Right, and it should translate into very nice returns for these technologies. As you can see, if you look at the market today, roughly 19 trillion of the 117 trillion in global equity market cap is associated with disruptive innovation. So let's say a little more than 15%. If we're right, and with Brett's guidance, our analysts have, built the building blocks for us to be able to say this. If we're right, that 19 trillion is going to scale to 220 trillion during the next really 7 years. So that's a 42% compound annual rate of return. And whereas the rest of the world, we see appreciating little or nothing at all. Why would that be? It's back to that creative destruction. The traditional world order is going to change radically. And the traditional benchmarks, the broad-based benchmarks, whether it's the S&P 500, MSCI World, and the NASDAQ, for example, they're not going to be able to keep up with this. And one of the reasons, we learned an important lesson from Tesla. The S&P did not put Tesla in that.
We opened up the model by saying, well, how much value is going to be delivered with AI software? And if I can, just like if I can deliver a robot to an Amazon or to a Tesla, and that can increase the productivity of their manufacturing base by X, they'll spend some fraction of X to install that robot, and then they'll get great ROI. It's the same with software and how it improves me and all of our analysts as knowledge workers. People pay for software that improves worker productivity. And if you look across all knowledge workers, there's almost $30 trillion in knowledge work wages that is going to be paid in 2030. So if you can improve their productivity by multiples and just pay a fraction of that, you still end up with trillions of dollars, and in fact, more than $10 trillion in our estimation, of AI software spend to help knowledge workers. And therefore, you need $1 trillion plus of AI chips to create that AI software. So kind of rather than approaching it from like, hey, this is IT spend and what people are going to do, we approach it from this is the output of the technology that's going to be installed, and therefore the amount of kind of justifiable, really ROI positive hardware we need to support that, and you end up with a much larger market.
So that begs the question, and before you leave us, we're going to show one more quite provocative chart. It says it all. But before we go, I know this begs a question. We have been shifting our emphasis